VC Properties has one of the widest moats you could have in the stock market. This is a stock that I used to own. It's now down 9% over the last 5 years. The company pretty much owns 70% of the Las Vegas Strip. It's a REIT, real estate investment trust, and they own a lot of some important real estate that pretty much cannot be replicated. Like they own the Caesars Palace, they own Harrah's, they own Park MGM, New York, Luxor, Excalibur, Mandalay. They even own the Strat. And they own so many assets on the Strip and outside the Strip that pretty much cannot be replicated. And now the company is trading at about a 6.6% dividend. This is the highest dividend in the company's history, backed by some very long-term leases. And a lot of people are hating on this one, and the market is saying that the dividend yield is not sustainable and the company is in major trouble. Now, I happen to believe that this is not true, and I'm personally seeing a pretty amazing opportunity that I'm going to talk about in today's video, and I really hope you enjoy it as always. Now, there's a few reasons why VC Properties has been going down. One of them is tenant concentration. So the biggest tenant of VC is Caesars. For a 29-year lease term, they have 18 properties with VC Properties, and 38% of total rent comes from Caesars. Then you have MGM with 12 properties with a 48 years weighted average lease term, very, very long-term leases, indexed to inflation, by the way. And that makes up 32%. If you combine the two together, they make up 70% of the company's assets. So 70% is just from two tenants. And if something happens to this tenant, something goes wrong, it could be really bad for the company. And this is exactly what's happening right now. You have Caesars Entertainment struggling a little bit. There's some kind of a private equity company that's interested in buying it. They're going to be acquiring it for about $18 billion. Caesars is also a stock that I used to own, and it was struggling a little bit due to some reasons in Las Vegas. One of them has to do with tourism. So a lot of people from Canada and other countries used to come to the United States more often, and due to the political climate and some of the political sentiment in general, some of it has pulled back. And you could even say the economy, higher fuel prices for jets and airplanes, higher airfare prices, those have weighted on tourism. But, Las Vegas also got a little bit expensive with all the fees and everything. But you also have what I believe is a major disruptor, and this is the poly market and Kalshi and all the prediction markets and sports betting and even online gaming, where people are not really as interested as they were of taking a flight, going to Las Vegas, paying the resort fees, paying all kind of taxes and fees just to gamble in the casino, when they can gamble on Kalshi, betting on the weather, or poly market, or gamble on some stocks that they have, or something within sports betting, and they can do it while sitting in the comfort of their homes. So this is the newer generation. They're more into the online stuff than physical stuff. And I think that could be a major disruptor, and that has also weighted on Caesars, which is why the company got acquired. But I personally believe that Las Vegas in general will likely be fine, as the company is diversifying away from just being a gaming and casino capital. It's more of an entertainment capital, and there's a lot of things that people are willing to pay for in terms of experiencing certain events. One of them is the Formula One, for example, which is going to be there through 2027. You have other sporting event. You have the Super Bowl coming up in 2029, and the economy of Las Vegas is diversifying away from just casinos, and it's more into entertainment and singers, and people love experiencing those real-life events that is just not the same as experiencing them on your phone. And if you want to go there, you're going to have to stay at a hotel, you're going to have to order some food, you're going to maybe do some shopping, do a little bit of a few things. And this is where Caesars and MGM can accommodate those needs, as it's not just a casino, it's a huge hotel, huge, entertainment space, huge, retail outlets and food and breakfast and all kind of things. So again, I believe Las Vegas will end up being much better than what a lot of people believe. But even VC Properties itself is diversifying away from just Las Vegas. It's going to take them some time, but they've been diversifying away. They acquired some regional casinos, which those are a little bit more, you could say, prone to the online stuff versus Las Vegas in general. But they've also been acquiring other assets outside of gaming. One of them is this resort in the U.S. Virgin Islands. It's a pretty amazing resource that they acquired, pretty amazing stuff. And this is something that's not going to be disrupted by AI or online gaming. People are still want to go on vacations. It's not going to be as putting your whatever VR headphones or whatever they are, and then it's like you went on vacation. I mean, people are still going to go on vacations. So those resorts are pretty valuable. They're not going anywhere. And they own the real estate. They don't operate them, which is pretty amazing to me. So I think Las Vegas in general will be fine. Now, in terms of the 6% dividend yield that people believe isn't sustainable, again, I believe otherwise. And I'm going to take a look at MGM's financials, because now you have Caesars going private. We're not going to have a lot of insights on Caesars, but we can at least talk about MGM a little bit. It's still a public company, and it's still 32% of their assets or of the total rent, okay? Now, if we look at MGM's EBITDA, so this is interest, so this is earnings before interest and tax, depreciation, amortization, and rent. So it's actually before rent. And this is the Las Vegas Strip operation alone. So it does not include the online MGM bet that the company owns. It doesn't include any international revenues. It just includes whatever they generate on the Las Vegas Strip before paying rent, okay? They generate about $2.8 billion, okay? Now, if we look at the rent obligations to VICI properties, it's about $1 billion a year, and the company generates $2.8 billion from the Las Vegas Strip alone before anything. This is pretty much a 3-to-1 rent coverage, very, very high, okay? Now, if we look at the company's free cash flow, which free cash flow is after paying rent, and it also includes the international revenues and everything that the company generates, they still have about $1.4 billion left. After paying the rents, after doing everything, they still have $1.4 billion of free cash flow to do buybacks or dividend or to do whatever. So if the free cash flow was like zero or positive 100, positive 200 million, we can say this is a huge concern, and maybe the company will default on the lease. But so far, I'm seeing zero signs that the company will potentially default on the lease. So I say you could say, square off MGM as a potential risk for VICI properties, and we could say the main risk for now is Caesars Entertainment. And the best way I can quantify this risk is mainly by looking at the company's AFFO per share, or adjusted funds from operations per share, relative to the dividend per share. Okay. Now, if something is going to happen with Caesars, I personally don't believe like Caesars is going to go bankrupt. Okay. I believe there will likely be a restructuring of the lease where VICI properties will likely be taking a haircut on the lease. This is the most likely outcome, in my personal opinion. Now, if we look at the spread, the company generates about 62 cents in adjusted funds from operations per share, and they're paying about 44 cents in dividend per share. Now, if they had to take about a 20 or 25% cut on the total AFFO per share, which is unlikely because we talked about the tenant profile, we talked about MGM being fine, the Venetian, and all the other ones are pretty much fine except Caesars. So if they had to take a cut on Caesars, it's unlikely going to be 25% of the entire AFFO. But let's assume it was, then it would still equal the dividend. So even if they take a 25% haircut on their AFFO per share, the company will have then about 100% payout ratio, and they can still maintain the dividend. So I actually believe that the 6.5% dividend is safe. I believe MGM is safe. Caesars could have some restructuring, but even if it did, the company's dividend yield will likely be fine. It would be about 100% payout ratio, but the company can still maintain it. So I don't believe it's really as bad as people believe it is. And if you really want to look at how cheap the company is, you could look at the price to tangible book value per share. Now, tangible book is, let's say a company is going bankrupt, or let's say you had to liquidate all the assets and you repay all the debt obligations. How much cash would you have left? Well, the company right now is trading at 0.98 tangible book value per share. So it's pretty much trading at 98 cents on the dollar. This is crazy for a company that owns such quality assets that really aren't going anywhere, guys. Like if it's not a casino, it's the hotels, it's just amazing assets. Those assets are not going anywhere. And you're buying it below liquidation value. That's really, you could say, something that I've never expected to see with VC. So I think a lot of the bad is priced in the company. The company is trading at 10 times price to AFFO per share. The average is about 13 times. And they grow AFFO per share 3%, 4% a year. So if they can grow 4%, you're getting a 6.5% dividend. This is almost an 11% annual return, excluding any multiple expansion. And I think it could potentially be powerful with VC from where they're trading at today, which is pretty much below liquidation value. So I believe the company is undervalued. I believe, the dividend is safe. I don't know what's going to happen. It will be interesting to see if I end up being right or wrong, but I think it's safe for now. I think, the main problem could be Caesars, but if it was a problem, it could be a haircut on the rent, so maybe from 1.2 billion to a billion or 900 million, and the company would still be fine, and it's unlikely to take off 25% haircut on their AFFO, but even if they did, the company could still maintain the dividend. So I believe the company is undervalued, and that's my opinion on VC properties. I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.